Hi everybody, I'm Don Bravaldo. I'm president of Bravaldo Capital Advisors. We're a boutique merger and acquisition as well as corporate finance advisory firm. That's a mouthful, but essentially what we do is help private companies buy, sell, and raise capital. Some of the biggest changes that businesses are facing in today's rapidly changing debt markets really include having to be very focused on something that for the last decade no one has thought about, and that's treasury, risk management, and depository banking relationships. This was brought on by the failures, of course, of Silicon Valley Bank and Signature Bank, and it's caused every business owner out there that wasn't directly impacted by the fear of losing some cash in those bank failures to really reevaluate their lending relationships. The current economic environment is definitely affecting the availability of debt financing as well as the cost of debt financing. Again, in the current market with the Federal Reserve continuing to raise rates and the recent bank failures, it's really ushered in an era of a very difficult time and period to access capital. So growing companies that need debt financing are going to find out that traditional bank lenders are going to be much more reluctant to lend. They are only going to be looking at really near perfect lending scenarios with perfect companies. And it's a rare day that I meet a perfect company. So business owners do need to be prepared to remain with their current lenders, make sure that they're paying attention to things called covenants, stay in the good graces of the current lender, make sure that you've done everything you can to have availability on capital. And if you're a current borrower, you've recognized most of the current borrowings are on floating rates, and the cost of that capital is going up and up each day. So I think that certain industries are going to continue to have a great year. In particular, we've noticed that in industrials and business services, those industries in general, those companies seem to be performing well. We believe as the year marches on and the Fed continues to tighten, to raise interest rates, and banks continue to tighten on lending, we are ultimately heading for what's hopefully a mild recession. When that starts, when it ends, it's above my pay grade. If I had to bet, I would think it would be sometime in the December timeframe to first quarter of next year. We're all fortunate to be located in the South, which is a growing area of the country. For many of us, that economic growth is probably going to make this a rather mild recession.
Thank you for watching. Please subscribe and click the notification bell to be the first to view GSCPA videos. Follow us on other social media for even more society news.